APR stands for annual percentage rate. It represents the yearly cost of borrowing money, including interest and fees, expressed as a percentage. Unlike a simple interest rate, APR provides a more comprehensive view of borrowing costs. For example, a credit card might advertise a 15.99% APR, which includes both the interest rate and various fees. APR is a standardized way to compare different loan offers and credit products, helping consumers understand the true cost of borrowing beyond just the interest rate. The annual percentage rate consists of several key components that together represent the true cost of borrowing. The first and most significant component is the base interest rate. This is the percentage charged for borrowing the principal amount. The second component includes mandatory fees, such as origination fees, closing costs, and application fees. These are one-time charges added to the loan. The third component can include required insurance premiums, such as private mortgage insurance for home loans with less than 20% down payment. All these components are combined and calculated to show the total annual cost as a percentage. However, not all fees are included in APR calculations. Late payment fees, penalty fees, optional service charges, cash advance fees, and optional insurance are typically excluded because they're contingent on borrower behavior rather than being mandatory costs. Annual percentage rates are calculated using a standardized formula. This formula converts all costs associated with a loan into an equivalent interest rate. The calculation takes into account several components: the base interest rate, any required fees and charges, the loan amount, and the loan term. Let's look at an example. Say you borrow $1,000 with a 10% interest rate plus $50 in fees for a one-year term. First, we calculate the interest cost, which is $1,000 multiplied by 10%, giving us $100. Next, we add the fees to the interest. $100 plus $50 equals $150 in total costs. Finally, we divide the total costs by the loan amount to get the APR percentage. $150 divided by $1,000 gives us 15%. Let's visualize the difference between the nominal interest rate and the APR. The nominal interest rate is 10%, but the APR is 15%, which is higher because it includes both the interest and the fees. This represents a 5% difference between the nominal rate and the APR. This is why APRs provide a more complete picture of the true cost of borrowing, as they include all required fees converted into an equivalent interest rate. Understanding how APRs are calculated helps you make more informed financial decisions. Fixed APRs remain constant throughout the entire loan term, providing borrowers with predictable monthly payments. One of the main advantages of fixed APRs is that they protect borrowers from market fluctuations and interest rate increases. However, they typically start at a higher rate than variable options. Variable APRs, however, can change over time based on an underlying index rate, such as the prime rate. They typically start lower than fixed rates. The main drawback of variable APRs is that they carry the risk of increasing over time, which can lead to fluctuating payment amounts that might be difficult to budget for. Let's compare how fixed and variable rates might perform over time. This graph shows a fixed-rate APR at 6% that remains constant throughout the loan term. In contrast, this variable rate starts lower at 4% but fluctuates with market conditions. Notice how it eventually exceeds the fixed rate after the third year, demonstrating the potential risk of variable rates. Different financial products typically offer different APR structures. Let's look at what's common in the market. Credit cards predominantly use variable APRs tied to the prime rate, which allows banks to adjust rates when market conditions change. For mortgages, both fixed and variable options are widely available, with fixed-rate mortgages being popular for their stability. Auto loans typically feature fixed APRs, providing consistent payments throughout the loan term. Personal loans offer both options, though fixed rates are more common for their predictability. When deciding between fixed and variable APRs, consider your financial situation and market outlook. A fixed APR is generally better if interest rates are expected to rise, you need predictable payments for budgeting, or plan to keep the loan long term. On the other hand, variable APRs might be more advantageous if interest rates are expected to fall. You plan to pay off the debt quickly, or if you can handle payment fluctuations in exchange for a lower initial rate. The key takeaway is that understanding whether your APR is fixed or variable is crucial for effective financial planning and avoiding unexpected costs. Let's examine how annual percentage rates apply specifically to credit cards. Credit card APRs typically range from 15 to 25% or even higher, depending on your credit score and the card type. Credit cards often have different APRs for different transaction types. These typically include purchase APRs, balance transfer APRs, and cash advance APRs, with cash advances usually having the highest rates. One of the most important things to understand about credit card APRs is that they only apply if you carry a balance beyond the grace period. The grace period typically extends from your statement date to your payment due date. If you pay your full balance by this deadline, you won't be charged any interest, regardless of the card's APR. Finally, it's important to know that credit card companies are legally required to clearly disclose all APRs in their terms and conditions. This disclosure must include the APRs for purchases, balance transfers, cash advances, and any penalty APRs that might apply if you miss payments. They must also disclose the length of your grace period. When dealing with mortgages and large loans, APRs include more than just the interest rate. Let's start with the basic interest rate. For example, a mortgage might have a stated interest rate of 4%. However, the APR also factors in additional costs spread over the loan term. These include closing costs, points, and origination fees. When these additional costs are included, the APR becomes higher than the stated interest rate. In our example, the 4% interest rate becomes a 4.25% APR. Understanding mortgage APRs is particularly important when comparison shopping between different lenders. Different lenders may charge the same interest rate, but vary significantly in their fees and other costs. As you can see, all three lenders offer the same 4% interest rate, but their APRs range from 4.15 to 4.40% because of different fee structures. This is why mortgage APRs are crucial for comparison shopping. Always compare APRs, not just interest rates, to understand the true cost of your loan. By focusing on the APR rather than just the interest rate, you'll make more informed decisions when choosing a mortgage or loan. Let's understand the key differences between APR and APY. APR, or annual percentage rate, represents the simple annual cost of borrowing without accounting for compounding effects. APY, or annual percentage yield, accounts for compound interest when interest is earned on previously accrued interest. The difference between APR and APY becomes more significant with frequent compounding periods. With a 10% APR, if compounded annually, the APY remains 10%. However, as we increase the frequency of compounding, the APY increases. From a practical perspective, the distinction between APR and APY matters differently depending on whether you're a borrower or a saver. Let's calculate how a 10% APR compounded monthly would result in an APY of approximately 10.47%. We substitute our APR of 10% and 12 compounding periods for monthly compounding. Dividing 10% by 12 gives us 0.833% interest per month. After calculating the compound effect over 12 months, we get a factor of 1.1047, which means an APY of 10.47%. This difference of 0.47% may seem small, but it can significantly impact long-term investments and loans. Your credit score has a significant impact on the APR you're offered by lenders. Credit scores typically range from 300 to 850, with higher scores indicating better creditworthiness. As your credit score improves, the APR you're offered typically decreases, which means you pay less interest. For example, someone with excellent credit might receive a credit card APR of around 16%. Meanwhile, someone with fair credit might get 25% for the same card. This difference in APR can translate to thousands of dollars in additional interest costs over time. For a $300,000 30-year mortgage, someone with excellent credit might pay around 4.5% APR, resulting in a monthly payment of once in $520. Someone with fair credit might pay 6.5% APR with a monthly payment of $1,896. That's a difference of $376 every month, or more than $135,000 over the life of the loan. Improving your credit score can save you significant money on interest payments for all types of loans and credit. The first strategy to minimize APR costs is to improve your credit score. A better credit score can significantly lower the APR you qualify for. For example, improving your score from 650 to 750 could reduce your APR from nearly 19% to 12.5%. To improve your score, focus on paying bills on time, reducing your debt-to-income ratio, and limiting new credit applications. The second strategy is to shop around and compare offers from multiple lenders. Different lenders offer significantly different APRs for the same loan type and credit profile. Be sure to compare at least 3 different lenders, check both traditional and online options, and look beyond just the advertised rate. Our third strategy is to negotiate with lenders for better rates, especially if you have good credit. Many lenders have flexibility in their rates. By negotiating, you could potentially lower your APR by 1 to 2 percentage points. On a $10,000 loan, even a 2% APR reduction could save you $200 per year in interest. When negotiating, highlight your good credit history, mention competing offers, and remain persistent but polite. For existing debts with high APRs, consider balance transfers or debt consolidation. You can transfer high-interest credit card balances to a card with a lower interest rate, often starting with a 0% introductory offer. Look for 0% introductory APR offers, but be mindful of balance transfer fees. Always create a repayment plan before transferring. Our final strategy is to pay off high APR debts as quickly as possible. Making only minimum payments can result in years of debt repayment and thousands in interest. By accelerating your payments, you can pay off the same debt in much less time and save significantly on interest. In this example, accelerated payments save you $6,500 in interest and 7 years of debt. To implement this strategy, pay more than the minimum whenever possible. Target your highest APR debt first, and consider debt avalanche or snowball methods for multiple debts.